Freddie Mac puts out a national rate survey, and for this week, they say rates across the country, on average, went up on a 30-year fixed transaction to 2.8%. They did say that the 15-year fixed rate went down just a hair to 2.1%. Now, I gotta tell you, as somebody that puts rate quotes together for people pretty much every day, I didn't notice really any changes of any note on my rates over this past week. Now, what I like to do is look at the mortgage bond data, and as people that have seen my videos before, they know the basic rule of thumb: as mortgage bond prices go up, that's generally going to push mortgage interest rates down. And what we've got on this 5-day view, you can actually see day after day after day this week, mortgage bond prices improved. This has contributed toward a really good, steady rate environment this week. Now, if we bump over to the 6-month view, you can actually see that mortgage bond prices right now versus slightly more favorable rate conditions last year, there's a pretty big gap there that in theory we would have to make up for the rates to actually get to like the rock bottom levels that we saw during last year. One thing to keep in mind, especially if you're refinancing, refinance rates actually got better due to the FHFA removing what was called the adverse market fee. I covered that in my last video. Feel free to check that one out for some context there. But by and large, from a practical standpoint, the rates that you're going to see today are going to be very, very close to the absolute rock bottom lowest levels that we saw during 2020. So now, looking ahead, I wanted to give you kind of a primer, a way to interpret various data that you may come across. Economic data is sometimes pretty obtuse. I think the average person, you kind of feel compelled to kind of pretend that, oh yeah, manufacturing data, great job, manufacturers. But a really good rule of thumb, if you're looking at mortgage rates and you're trying to figure out whether to lock or what rates are going to do based on various factors going forward, the rule actually is it's shockingly simple how to interpret any number of economic reports. If economic reports come out that are good, like good meaning good for the economy, favorable for the stock market, that is generally speaking going to be bad for the mortgage bond market. Bad for the bond market, therefore generally bad for rates. Now, before going into some specific economic reports that are coming out next week, I wanted to cover the other two key movers of mortgage rates going forward. And number one is COVID. So COVID, as I've stated many times before, is the single number one thing. It is now several hours later. I'm currently in the midst of editing the video that you're watching right now, and I am also consuming Starbucks coffee that I ordered this morning, which is gross, but that's kind of where we're at right now, and my cat is running across the frame. The reason that I've interrupted you is I just discovered that I referred to COVID very uncreatively, simply as a thing. I need to do better with my word choices, and I will endeavor to do so in the future. But one thing that could help me is if you could click the like button. That'll help spread this content to more people. The more people that I know I am accountable to, the better I will be at this whole mortgage video thing. And if that is not reason enough, just look at this guy. Dinkerton, say hello. Say hello. So one of the reasons that the rates took a dip over the last month or so is because of increased concerns over COVID. Now, if COVID becomes less of a concern, if there's very favorable data that comes out, that is generally speaking going to push rates up. The next thing to look at, also very, very critical, is the Federal Reserve. Now, the Federal Reserve, due to concerns over COVID and a faltering economy, they started buying up a bunch of mortgage bonds. They have been throwing a truly inconceivable amount of money into the mortgage bond market, which one could argue has kind of artificially pushed rates down. The thing that I have been nervous about is the tapering of this program, that the Federal Reserve may stop buying as much in the way of bonds. They may stop buying them entirely. And when that happens, trust me, rates are going up. But the Federal Reserve this week kind of deferred to COVID and overall economic data. They basically said, look, we're not interested in tapering any of this stuff until the economy shows some serious signs of life, until unemployment data gets significantly better. We're going to kind of hang out and do what we're doing. So that is a good indication of why the rates are as low as they are right now. And it could also mean that maybe we're in a little bit of a stable pattern here, which would certainly be nice. So looking at the economic reports coming out next week. first one up that could move the market is on Monday, and it is a report from the Institute for Supply Management. Now, this is a manufacturing data report. The reason that it's a market mover is that the stock market really cares about it. If the manufacturing data is especially positive, or if it exceeds the expectations, if it's good for the stock market, again, like I said, that rule that I mentioned earlier applies. Good data will be bad for mortgage rates, so look at that. So on Wednesday, we've got the ADP employment report. If the employment numbers from ADP come in really favorably, stock market's going to like that. The bond market isn't going to like that, and mortgage rates, generally speaking, are going to be pressured to go up. Friday, we have two reports coming from the U.S. Department of Labor, the non-farm payroll report, and then, of course, the big unemployment report. These reports are watched very, very closely, specifically people that are trading on the stock market and in the bond market. Again, the simple rule applies. If it's good news for the economy, that's going to put pressure on rates to go up. If it's bad news for the economy, that could either keep rates where they're at or possibly improve them. So where I wanted to end with all of this information is to give a recommendation. Now, when anybody asks me, should I lock or should I wait to lock, whether they're looking at a refinance or maybe they have a purchase under contract, that question, the only way for me to answer it honestly is I have to defer to you and what your overall risk tolerance looks like, where maybe you can self-define your level of risk tolerance, the amount of risk that you're willing to take on in exchange for some potential benefit. So we have the not very risk averse at all group. These are the gamblers. I'm definitely going to recommend that you float. Particularly if the reports that come out next week are bad, like Monday, the manufacturing report, if that comes in worse than expected, that could be a good indication that there's going to be some pressure that's going to push those bond prices up and could bring mortgage rates down by a bit. Certainly if throughout the week that theme is repeated, by Friday you could see a better situation as far as rates are concerned. Now the next group is the more moderate group. I would say even for the moderate folks, the risk of the rates jumping on us at this point, I think are very minimal. We've had a really solid week in the bond market. I think it's going to take some sustained negative news for the bond market to really move the needle in a bad way on these rates. Now finally, if you're in the group, which I got to tell you, I'm in this group personally. I don't, especially in this environment, I don't have much in the way of risk tolerance. In my experience, given that I've been doing this almost 17 years, if you had told me, I don't know, really any time before last year that I would ever see rates with a 2 in front of them, and not only that there would be rates with a 2 in the front for like a sustainable period of time, I would have told you either A, you were crazy, or B, and I remember telling people this, or B, that there would have to be some sort of like global pandemic type situation. Well, unfortunately, that's obviously what happened last year. Given the fact that the rates, to me, it's still just astounding that we're seeing rates anywhere near as low as they are. I'm almost always in the camp of saying, you know what, if you like it, lock it. These rates are great. But again, I understand that if you have a little bit more tolerance for risk, I'm trying to do my best to kind of put myself in your shoes and interpret the data from that perspective. So if you or anybody that you know is looking to refinance, or if you've got a purchase under contract and you'd like to take a look at your mortgage options, if you're looking for the person that's just going to tell it to you straight, that's going to give you the math, that's going to give you the super transparent information that you need to make an informed decision, that guy is me. Give me a call, shoot me a text, and I would love to have that conversation. Thank you so much for watching. I will talk to you again soon. That scared the crap out of me. He currently just attempted to bash down the door. I actually thought it was a human intruder of some kind.